Okay, so let's learn how to assess free cash flow. Free cash flow, for those of you who don't know, is calculated by taking the net cash from operating activities and subtracting capital expenditures. For more info about that, just watch our free cash flow video by clicking right over here. Anyways, let's get started. Many successful value investors assess free cash flow in relation to price. So essentially, a price to cash ratio. It's like the price to earnings ratio, but instead of earnings, we use free cash flow. So when I say cash, I mean free cash flow, not just cash flow. They're two different things, so don't get them confused. So remember, when I say price to cash, I mean price to free cash flow. In order to use the price to cash ratio, you will need to know how to calculate the free cash flow per share. It's a simple calculation. Free cash flow divided by outstanding shares. So now that you have the price per share and the free cash flow per share, you can calculate the price to cash ratio. The price to cash ratio tells you how much you're paying for every dollar of free cash flow. For example, the price per share of company ABC is $27 and the free cash flow per share is $3. So this means company ABC has a price to cash ratio of 9. So you're paying $9 for every dollar of free cash flow. So let's compare this with another company. Company ABC has a price to cash ratio of 9. And let's say company DEF has a price to cash ratio of 15. With ABC, you're paying $9 for every dollar of free cash flow. And with DEF, you're paying $15 for every dollar of free cash flow. As you can see, company ABC would be a better deal because you're paying less money for the same amount of free cash flow. When getting your free cash flow figure, you want an accurate number. And to do this, you should take an average from the last few years. I say this because if you take the current year's free cash flow and say the company got lucky and did really well that year, how likely is it that they'll continue to do this in the next few years? And same issue goes with if the company had a really bad year. If the company is strong and consistently does well, you shouldn't judge the free cash flow based on that bad year. So what I like to do is I like to take an average from the last 3 to 5 years. Let's say company ABC had free cash flow of $90 million in year 3, $220 million in year 2, and $150 million in year 1. Year 3 was probably a bad year for them. Who knows, the business may have gotten unlucky, or maybe the market was just doing bad as a whole. But to get an accurate estimate, just take an average of these 3 numbers, which equates to $153.3 million. So from here, just make an estimate. You might want to use a free cash flow of $150 million. I would personally use $140 million simply because the company did bad last year and I want to be conservative. It all depends on what you as an investor feel is going to happen. What free cash flow do you think they will be able to produce next year? I will say $140 million. Another person will say $160 million, and another will say $150 million. It's up to the investor. Sometimes the investor has to make estimates. In the words of famous British economist J.M. Keynes, I'd rather be vaguely right than precisely wrong. In the case of some companies, capital expenditures may outweigh their net cash from operating activities, thus giving them a negative free cash flow. This means that more money is being invested than is being made. This can be a good thing or a bad thing. What this means is that management is taking a risk by putting large portions of the company's cash into investments. Here's a quote. What successful value investor Bruce Berkowitz is saying here is that if these investments prove to be useful and lead to prosperous growth, it can increase shareholder value and benefit you. But if these investments prove to be huge mistakes and result in no growth or losses, your shares are in trouble. In conclusion, go with companies that have low price to cash ratios. And if there are some companies that have lower free cash flow than you would expect, do your research and find out what their management is investing in so you can make an informed decision.